Hello, Jimmy. How you doing?
Jeremy, I'm doing wonderful. How are you?
Doing well. Here we are in the second quarter of 2026. It's towards the end of April now.
Done with tax season?
Done with tax season, which is fantastic.
Yep.
That went really well, and I'm glad that you're through with that.
Yeah, I am as well.
I'm sure you are. So here we are talking about the market insights as we do at this time in the quarter every quarter. And, we've got some curveballs that it's thrown us, in particular the Iran war. We'll talk about that and a
Yeah.
whole bunch of other things. So here we go,
Let's
right?
go.
All right. Our portfolio points for today are going to be sort of a trifecta at first here: war, oil, the stock market. And then we'll talk about artificial intelligence and now what or what's next.
Yeah. Great question.
All right. Getting right after it here. The Iran war. I would say nobody really saw this super coming.
Yeah,
Right? It's
right.
not like this one was some long, drawn out build up, and we were all of a sudden, we were there, but it took a while. No, this was sort of almost an overnight affair.
Yeah, right. Absolutely. And obviously there's no way to completely diversify your portfolio away from geopolitical risk, but this certainly wasn't at the top of the list on the bingo card, as some people like to say, right? It didn't have this on my bingo card for this year, but
Yeah.
it is what it is at this point. The market is digesting what's happened, and obviously oil and energy has been a major variable in the markets.
Well, no doubt. I mean, if you want to just go after it straight away, I mean, Iran is in the Middle East, and this is where a lot of the world gets most of their oil from.
Sure.
It so happens that the United States and North America doesn't really get most of its oil from over there, but we are all caught in the same cauldron because it is a global commodity.
Right.
And so what we're looking at here on the chart is going to be Brent crude, which is the international crude oil benchmark,
Right.
if you want to call it that. And it was pretty range bound as oil has been for a while.
Right.
It was in the 60s pretty consistently. And then all of a sudden, boom, I think it was the weekend of February was 28th, I want to say maybe. And so that was a Saturday, I think, that the thing hit. And then off to the races. Crude is off to the races. And then
Anything
you
but
can see
range
it
bound.
just skyrocketing upward. I think it hit, 60% up at its right around there, give or take,
Right.
at its highs. It's sort of settled back down to 40%. But this is what commodities can do.
Right. Yeah. They can be very volatile. Right.
Super volatile. So
I mean, I think what's interesting to me here in understanding how short this time period is, right? We're looking back to February, and here we are in April. I mean, and the amount of the movement and the swings in the purple line here that represent the Brent crude price. I mean, those are some just crazy moves. And then you look at the corresponding market. How are the different stock markets digesting this, right? So we're looking at international, developed international, emerging market international, and then our U.S. stock market. And I mean, yes, there's some movements in the stock markets, but they look very, very tame relative to the Brent crude,
I
right?
have to agree the same. When you look at it at this chart, I would say there was a few moments within the last 2 month frame where it felt like, yeah, it was pretty bad, pretty
Yeah.
dire. But it was never that black swan moment that you thought it could have been
Right.
with something like the closing of the Strait of Hormuz.
Right.
I don't think that was really in the calculus for our administration. And here we are, it's on again, off again, sort of, is it a viable strait at this point? The backstory on that is not necessarily those tankers couldn't go through, but the risk of them going through has their insurance company
Yeah, the
saying,
insurance companies, no
don't
thanks.
even try it.
Yeah,
And
not going to happen.
So they're just sitting there
Right.
until they get quote unquote safe passage until this thing sort of settles in. We're in the middle. We're actually towards the end here of that 2 week ceasefire.
Right.
So what happens from here is anybody's guess.
Sure.
But you're absolutely right. I mean, like, look, the stock market, it did crater a little bit, but it stayed relatively, on nonplussed with the whole event, um, on a whole.
Yeah, well, look, I think over the long term, one thing that we do know is that stocks tend to follow earnings, and yes, this could be a temporary disruption of what's going on in the market, but over long periods of time, the same companies that you're looking at that make up the benchmarks that we're looking at down here with the stock market, these companies are all still trying to figure out how to make money,
Yep.
regardless of what's going on geopolitically. Um, so it's not incredibly surprising that it's been as muted as it has been.
Yeah. We were talking about there was a moment in time where it was oil up, stocks down,
Yeah.
and there's that correlation still exists today, of course,
right,
but maybe not as pronounced.
I would totally agree with that.
And we'll see whether that sticks around, but maybe that's the trend that we're in. All right, so we wanted to take a wider view of this, put it in the context of history, as we like to do oftentimes. So just so our viewers can kind of get an idea of what's going on here. In the box there, you're going to have the 1, 5, and 10-year returns after these different major war events, conflicts that we've been involved in as the United States over the years, going all the way back to World War II. And then the chart shows you, the number of days, trading days since that war start, and where the market has gone from there.
Right. So, part of this, I like to see the data to, understand, what has happened historically. I do think that sometimes when you're looking 10 years out from the onset of a war, some of that data could be a little irrelevant relative to the event that you're tracking from the beginning of that time period. I like to focus more on that shorter midterm portion of this graph. And I think what you can see is there's quite a bit of randomness in there, but it's all tightly packed in. Some are okay, some are not as good in the shorter time periods, 1 to 3 years.
Certainly seems that way. That's
pretty tightly wound up in there in the first couple of years.
I got to admit, I think that's the case here. I mean, you see the big divergence at the end, and maybe your eye kind of goes to that part in the chart.
Right.
I think that's the least relevant part. I think the more relevant part is that the markets are sort of gummed up, wound up together in that first year or two of these events, or from them. You start to see a divergence over time.
Right.
Which means that they do have an impact on the market. Nobody's saying that they don't.
Right.
They just don't have a lasting impact on the market.
Yeah, I think that's a very fair assessment. We talk about the market in the short term can be a voting machine, and the long run it's a measuring machine.
Okay, I like that. Yeah, I think that's accurate with what we're seeing here.
Yep.
So then you kind of also put this in a more incisive viewpoint. Look at the S&P 500. Go back to 1980, and what we know is volatility is normal.
Right.
So these 5% pullbacks that you have in the marketplace, on average, there's about 5 of them per year. 5 pullbacks of 5% or more per year. And clearly there's some years in here that show you that there's some extraordinary volatility. In this century, of course, we know that the early 2000s with the bubble from
the dot-com
bubble was a real phenomenon, that we had the great financial recession. Okay, got it. But then you go back like more recently, it's been pretty calm.
Yeah, but it really has been. And sometimes I think people can get like lulled to sleep a little bit because of how calm, for lack of a better term, the markets have been for the last few years. I mean, there have been these little blips on the radar, right? I mean, if you think back to last year, it looks like we have 5%. Well, you had the tariff tantrum, right? That you had, 4 or 5 trading days in a row that we're seeing 4 to 5% drawdowns. So 6, but many of those were packed into a very brief episodic moment of the market last year. So, of course, there are always going to be stories and explanations for each year. it does jump out to me. I mean, the 2008, you can't take your eye off that. It's like
Hard. Yeah, 24.
unbelievable. That's crazy. But yeah, we're still, right now, like I guess technically kind of trending towards an average volatile year.
Yeah.
In terms of 5% pullbacks. We're at one thus far.
Roughly 1.25, I guess, if you want to call it
Yeah,
that.
and you're kind of close.
Yeah.
So, and I think we've talked about this before, though. We were expecting volatility to be, increased this year. We didn't project that there was going to be a war that would,
Kickstart it.
kickstart a little bit, but here we are.
Here we are. So I think the message that we would want people to do to absorb here is simple. This is gonna happen.
Right.
Don't think too much about it. It just happened to be a war that as you said jump started at this time. Yeah,
for sure.
And this is a version of a slide that we've shown to our audience before. JP Morgan has also done a really nice job of illustrating this. And the simple truth of it is you're just best off riding out whatever the storms are.
Correct.
As an investor. So if you invested $1,000 25 years ago and you just stayed fully invested, you'd end up with about $6,000. Great.
Yep.
Fantastic. You missed the best day out of that 25-year period, and all of a sudden goes down from $6,000 to $5,300.
Right.
All right, then let's say you missed 10 days. All right, you're more than cut in half.
Yeah. It's
10
wild.
days out of 25 years.
It's wild. And the other part to that, I think that has been explained well in some of the previous slides we looked at similar data, is how tightly connected the best days and the worst days are. Right? So that's the component of the should I get out of the market and wait to get back in until everything clears up. That's the part that goes completely misvalued in my opinion. Mm-hmm. Of course it makes sense to me. If I knew when the market was, it's very volatile, let's get out, and when things get better, that's when we get back in. Of course, it sounds very logical.
Yeah.
But the correlation of the best days and the worst days and how tightly connected they are makes it a futile task to try to do that market timing. And I think this chart is a great objective way of proving that out.
It is, and it just says, hey, stay the course.
Right.
It doesn't mean you can't make some tactical shifts in your allocation.
Of course, right.
It doesn't mean any of that, right? But as far as big strategic moves, stay the course. All right, we're going to switch to AI.
Mm-hmm.
Again, a historical slide here going back to the 1920s, and it's looking at these different eras of different technological change. You had the nuclear power age, you had space age, personal computing revolution, internet era, which we've been in for quite a while here now, and now more recently we've switched to this AI environment.
Okay, yeah.
So, and look at what the stock market has done. It's moved up the line pretty consistently, pretty ratably.
I mean, technology and innovation has continued to be a good thing for the market and over the long term. Obviously, I'm sure there are data points, that predate both of us here that folks probably thought the technology was going to ruin the economy because it was going to take away everybody's jobs, and it just hasn't turned out to be the case. Right. So yes, AI is the new latest craze, and I think it's certainly exciting in many ways. It can be potentially scary for others in other ways, but over the long term here, technology and innovation has been great for stock prices.
I agree, and this is not news breaking, but I'm just going to say it anyways, is that AI, yes, it can be a little scary, and I do think it's changing certain jobs. There's no doubt about it.
Yeah, of course.
And it's going to eliminate some jobs in the marketplace. It's going to open up other jobs that we just don't quite understand and know yet.
Right, agreed.
Is it going to have a sizable impact in taking the total amount of job opportunities to a lower number?
Possibly.
I think it possibly could.
Yeah.
Right? But again, that is still, it's not independent of the stock market, but the stock market is still going to look at this in its totality.
Right.
And that's what we have to do as well as investors.
Right. Correct.
But, and we've had something similar to this that we've shared before. We thought it was really good to bring it back into frame again. Who's the next beneficiary of the AI trade?
Right.
We know that in the first round, the very, very early round, it was this tech stack environment,
Yep.
where you had, sort of your obvious players within
I feel like
the
Nvidia was a name that was just like
semiconductors.
always the rage, right?
No doubt, no doubt. And these folks are going to continue to play in that space and be beneficiaries of it. They're creating markets, they're creating more opportunities for themselves all the time in
Right.
these spaces. But then it's going to kind of shake off into secondary beneficiaries.
Yep.
We saw this a little bit over the last, call it 18 months or so. Utilities, they aren't using AI to do anything that's better
Right.
yet. Maybe
Yeah.
they will with their grid systems.
Right.
Okay. But right now, it's been more of a playbook around data centers need a lot of energy, so these utilities are getting a bid.
Yep. Makes sense.
It's going to play out in other ways too, right? The tertiary beneficiaries, which is not to say that they're really like lower level beneficiaries.
No,
they could be higher level.
Correct. Yeah,
beneficiaries.
that absolutely, the magnitude of their change could be far greater than the initial, the Nvidias, Broadcoms, these third tier that we've got listed here. The magnitude of their change could be far greater.
I agree, and one of the ones that sticks out is healthcare. So.
Oh yeah.
I was reading just recently, and it's basically about 5% of drugs get approved by the FDA. It's a pretty low number. Obviously, you've got to hit a lot of,
I guess so.
You got to hit a lot of marks in order to get past the FDA. Well, what if AI were to, kind of help the process of, DNA mapping, you name it, right? All the different things that it can do to speed up a process and maybe make the process more likely that it's going to go from 5% to 7 or 9 or 10%
right
approval rates.
Yeah, again, I think there's just still so much that is unknown at this point with AI, and what are the the use cases and implementation and beneficiaries. But I think it certainly is exciting to think about some of the advancements that could be on on the horizon here.
Exactly. The last thing I'll say too, and I'm stealing this from somebody else, but they said, when we in the 1800s, when we were building the railroads across the United States, you would have thought it was the rail companies that were going to be the only beneficiaries, perhaps.
Right.
In fact, long term, the rail companies hadn't done, they're not obsolete by any means, but they're not the lions of industry anymore.
Right.
But all these different companies that were able to take advantage of it, whether it be manufacturing,
Sure.
Retailers,
Right, the materials,
all the ability to move product around in an efficient way. It played out in a very similar way to this with a different technology.
No question. Yep.
It's your favorite chart here,
My
Jimmy?
favorite, the periodic table of returns. I think what jumps out at me, like when I started looking at this, and I always love looking at this chart. So the two columns on the far left here show you the range from 2011 through 2025. And so when you're looking at the difference here between the year to date, the column on the far right, with the column on the far left, the annualized rate of return for commodities is by far the worst returning asset class over the last 15 years. And then year to date, we're number one. So, and then looking at all the the individual lines for the years across the top, only one other year have commodities been the top returning asset class. So not to say that there isn't a spot in portfolios for commodities, but I think this chart really kind of caught me off guard, just realizing how infrequently commodities have been up near the top of the chart here,
and how sort of disruptive it can be to the rest of the assets within the periodic table here.
Oh yeah,
right. Because when input costs, transportation costs, all go up dramatically as they can and as they have.
Yep.
it puts a real attenuator on everything else, and it kind of pushes it down a little bit.
Absolutely.
So we're in that mix. Commodities are, certainly they're oil, but things like fertilizer, and then therefore things like food. These things are all potentially going to rise as a result of this war in the Middle East.
Right.
And so we'll see how long it lasts. But yeah, it has like a very jolting effect on everything. But at the end of the day, you also look at the other thing that's interesting to look at, which is the asset allocation, the white box. It is always kind of that range bound in the middle.
Right.
And it's still remaining so, even so far this year, despite the fact that commodities are at the top. Fixed income, which might be 30-40% of some people's portfolios, is at the very bottom, right?
Not a great year so far for the bonds.
Not great year for bonds so far, but we'll see how that plays out when maybe there's a little bit less fog, more clarity around rates and inflation.
Right.
We should get a better understanding. But listen, at the end of the day, always a great chart. So again, what's next? What is next is very hard to predict the future. We all know that, so we oftentimes look in the rearview mirror to figure it out.
Right.
Okay, so this year happens to be an important year in the election cycle. It's a midterm election cycle.
Right. So the midterm, looking at this, the two sets of the bar graphs here, you've got all the years going back to 1933, and then we exclude 2002 and 2008. If you want to view those as anomalies and outliers. But obviously the midterm election years have seen the least amount of appreciation in the markets. And I don't think that's terribly surprising. There is that other data point that we've looked at and talked about before, but how good the market is post the midterms.
Mm-hmm.
Like once you get through that, it seems to be like a real hurdle for the markets.
Yep.
That it does not like that midterm uncertainty. However, once we get past that, the November elections, the market seems to, be refreshed.
Yeah, no doubt. I think it's almost like the refresh is a good word. It's like we sweep off all the dust and the dirt that's out there from associated with these darn elections, because at the end of the day, they give us a lot of trepidation about what's going to happen.
Right.
And oftentimes you are talking about a changing the guard in the midterms, because almost all the time the party that's in power is gonna either acquiesce a majority to the other side,
right,
or a significant number of seats potentially, anyways.
Right.
So it's a changing of the guard at the same time, and so the market just kind of needs a little bit more clarity on what's going to happen next and how that's going to play out. So here we are. At the end of the day, the thesis still is for 2026 to be a reasonably strong year. There's no reason to think that it's going to be all doom and gloom. We would tell you that it's been extraordinarily resilient so far.
Yeah, I would totally agree with that. Earnings forecasts still look really strong. And I would just go back to the most important thing here is there's a lot of different variables that we've talked about with stocks and bonds. Make a plan. If you don't have a plan for how you're allocating your investments, it's going to make you more likely to make mistakes that will cost you potentially dearly in the long term. So make a plan, figure out how you should be allocating your money, and stick to the plan.
Wise words as a certified financial planner. Thank you very much for that. Well, that's all we have, folks. If you need to get a hold of us, here we are, is our slide. And happy to answer any questions that you might have, or if you want a plan run for your portfolio, let us know.